Well, thanks for having me here and giving me the opportunity to present my work. This is joint work with Roberto Steri, who's also in Lausanne. What we do in this paper is that we're going to look at how banks react in their investment decisions to being subject to the most intrusive form of regulation and supervision. So we are in the post-crisis regulatory environment in the US. And we start with Dodd-Frank Act. Dodd-Frank Act has brought many different provisions to stabilize and make the financial system safer. But arguably, what has changed the day-to-day operations and life of risk management teams is the fact that they are subject now to regulatory stress tests. So these are the annual stress tests of banks in the US since 2011. What those stress tests do on the bank is to increase the capital requirements, because next to the usual capital requirements that banks have, they now have to hold an extra buffer of capital to absorb those hypothetical losses they would suffer in the stress scenario that the Federal Reserve has designed. Okay, so you have higher capital requirements for banks that are subject to stress tests. And you also have this, what we call the supervision effect, actually what the Fed also called the supervision effect, which is that the Federal Reserve now is giving additional scrutiny on the bank investments and processes. The Fed is collecting at the bank level billions of data, not just collecting this data, but also analyzing the sensitivity of asset values to the stress factors that are used in the stress scenario. They also evaluate risk management teams, going on-site at the banks, interviewing the teams on key areas that range from corporate governance to stress testing methodologies, challenging banks about the assumptions that they're using to derive their risk weights, the capital charges for certain exposures in the credit risk models. So as you might have understood by now, the stress banks are not stressed. It's more actually the bankers that are stressed. But these banks are actually the banks that are subject to the stress tests, to this highest level of regulatory scrutiny, this very intrusive form of supervision. And what we're asking in the paper is whether stress test supervision is effective. And to answer this question, very simple question, whether stress tests reduce risk-taking incentives of banks on their asset side, whether banks are actually doing more prudent investments when they are subject to stress tests. The easy answer is yes. But to see it, you have to disentangle the effect that stress tests have on capital requirements, on capital regulation, from the effect of supervision. Okay, because stress tests have this effect on capital requirements, banks are going to respond differently to the level of the capital requirement. And to assess the effect of the rest of what the stress test is doing, which is supervision, we need to actually disentangle between the two. The innovation of the paper is hopefully to credibly disentangle these two effects, regulation from supervision, and show that stress test supervision, this very invasive type of supervision, is actually effective in reducing risk-taking at those large banks. Is it obvious? Well, now we're 10 years after the financial crisis, and stress tests are very criticized by politicians because they think that this is expensive. Of course, this supervision, you can understand that this is more expensive than just setting a capital requirement at a higher level, because you need this all these economists, the skilled economists going on site and so on. This is this is resource intensive, and of course, politicians are going to criticize the budget of the Federal Reserve that is allocated to the stress test. The academic side also is kind of hinting to the point that we don't see actually in crude measure of market risk an improvement or a reduction in the riskiness of the large banks that are subject to stress tests. And I mean, what does that mean is apparently that market participants don't view those large banks as being less risky compared to previous, the period previous to the crisis. Okay, so this is just crude estimates, but it's still puzzling. And then, I mean, we are already in this trend of deregulating and reducing supervision initiatives in the US. Since 2017, actually, a couple of banks have been exempted from the most constraining part of the stress test, and I'm going to talk about this later. But also, right after Trump came into office, there was this proposal of a Financial Choice Act to repeal Dodd-Frank Act. And in the Financial Choice Act, there was this off-ramp rule saying that banks could be exempted from stress tests if the capital ratio would be above 10%. The factor regarding capital requirements and regulation as a substitute to stress test supervision. Now, this has not been passed by Senate, but it has been on the table, could come again on the table. And basically what we're asking also in this paper is whether higher capital requirements could be a substitute to stress test supervision or enhanced supervision. So we're going to try to understand how stress tests actually affect bank risk-taking, and we have these two channels. One is higher capital requirements. As I said before, these banks need a larger buffer of capital to withstand losses that they would make in a stress scenario. And here in the theoretical literature, we find that higher capital requirements can go in all directions in terms of influencing risk-taking. They can lead to more risk-taking when banks want to compensate for a higher cost of funding and taking more risk on the asset side. It can lead to less risk-taking, and this is the usual reduction of moral hazard argument. Shareholders now have more skin in the game. Then you have more complex relationships between capital requirements. The direction of risk-taking will depend on whether equity is scarce or not. I mean, all those papers argue that capital requirements, even though they might influence risk-taking in different directions, is an important or crucial determinant of bank risk-taking. In the paper, we're not going to take a stance on the direction, but what we're going to do is to say, you have to control for capital requirements if you want to see what is left, what else is affecting bank risk-taking. Okay, so capital requirements is apparently a very important determinant of bank risk-taking. Once you have control for it, then what is left is everything else that the regulator is doing or the supervisor is doing that is not affecting the level of the capital requirement. What we take as an example is what I was talking before, this constraining part of the stress test. The most constraining part is actually not the part that is influencing the capital requirement, but is actually what the Federal Reserve is calling the qualitative exercise, which is these interviews on site, this evaluation of risk management teams on different areas. And since 2014, the 10 banks that failed the stress test were not based on not achieving the capital requirements, but were based on this qualitative part. Okay, so what are we going to do in the paper? We're going to assess the effect on risk-taking, and for that we need measures of risk-taking. Okay, so we're going to look at new loans a bank makes after learning its new capital requirement in a stress test. And we're going to look at two measures. One is the ex-ante promised yield on new loans, which is a first measure of risk-taking. And, well, because we're not in a perfect competition here, because we have large banks that could still affect yields, we're also going to look at the rating of the borrower that the bank grants a new loan to. Okay, so the first analysis is at the bank level. We're going to look at the average yield on the portfolio of new loans of a bank. This is a definitive setting, so we're going to compare what we call the stressed banks with, so these are just the banks that are stress tested, with the next largest banks in the US that never have been stress tested. Okay, so, and we're going to look at the differential response of these two types of banks to Dodd-Frank Act. And it's actually a triple definitive because we're going to control for another dimension, which is the capital requirement. Okay, so we're going to hold the capital requirement constant. What that means is that we're going to allow banks to react in their risk-taking behavior differently, whether you're a stressed or non-stressed bank, to capital requirement. So there's a differential response of bank risk-taking to capital requirements. We're going to allow that because we know that stressed banks have higher capital requirements compared to non-stressed banks after the Dodd-Frank Act. Once we have controlled for that, the remaining or residual differential response of stressed banks is going to be attributed to the effect of supervision. Okay? Because in our setting, supervision is everything else that is not affecting the level of the capital requirement. Then we go for identification, we go a bit further than that. So as I said before, we have stressed and non-stressed banks. The non-stressed banks are smaller banks, okay? So there's the predetermined size threshold that is written in Dodd-Frank Act. And because there are smaller banks, we're also concerned with the fact that size is only the only factor explaining this supervision effect. So what we're going to do is that we're going to look at regressions at the loan level and saturate in that regression with fixed effects. So to take into account this heterogeneity in supply of loans, because we have large and less large banks, we're going to add bank time fixed effects. So we completely control for the level of supply of loans. And because we are going to look at the syndicated loan market, we're going to also be able to include firm time fixed effects. What that means is that we have many observations, which actually this is the typical setup of the syndicated loan market, where you have one firm borrowing from multiple banks at the same time. Okay, so here we're going to also remove all the heterogeneity in loan demand, such that our results are not driven by banks basically lending in different areas that are recovering at different rates from the crisis. Okay, so that is an important part, because that means that we have to keep all members in the syndicate and not do the regression only for the lead arranger as it has been done in the literature before. Okay, so that's why we had to collect all this by hand. So we're going then to have only one dimension that is left, which is the matching between firms and banks. Okay, and still in that dimension, we're going to control for bank size times the firm rating. We still take the same difference setting here, controlling for a differential response to capital requirements of stressed and non-stressed banks, and looking at the remaining variation, the remaining different response to Dodd-Frank Act that we will attribute to supervision. Okay, so the results in a nutshell. And after that, I can pick some results to show. But the summary of results is here. We actually found that it is the case that banks differ in the sensitivity to capital requirements and the sensitivity of risk-taking to capital requirements. The sensitivity of risk-taking to capital requirements had decreased since the Dodd-Frank Act, because now banks have much higher, larger buffer of capital, way above the capital requirements, which could explain why they don't respond anymore or that much to capital requirements anymore. But it has reduced less for stressed banks. This sensitivity has reduced less for stressed banks because there's still this surprise component to the capital requirement that is coming from the Federal Reserve every year at the stress test disclosure date. This is not the core of our paper, but what we're saying is that this is an important control to have if you want to highlight the effect of stress test supervision. And what do we find in stress test supervision is once you have control for the level of capital requirement, we find that the average yield has increased for all banks after Dodd-Frank Act, fine, but by almost 200 basis points less for stressed banks. We find that stressed banks tilt their portfolio towards risky firms less, so they actually engage in more prudent lending and find a relative improvement compared to non-stressed banks of the average borrower rating by 0.7 classes. We have other results that I'm not at all going to talk about today because I don't have the time, but basically looking at still at the quantitative exercise and basically the fact that the Fed is applying a different capital requirements to this higher capital requirements to the bank, and we're going to show that this correction that the Fed applies to the capital requirement of the bank induces the bank to engage in more prudent lending as well. So the results here are highlighting the effectiveness of stress test supervision in encouraging prudent lending. So now I don't have much time left to show the rest, but I have talked about basically the broad overview of the paper. So I will, how much time do I have left? 4 minutes? Okay, so I can quickly explain the risk-sensitive capital requirement that we have in the paper. So basically, all banks are subject to 4 capital requirements on 4 different capital ratios. And we're going to basically look at all these capital requirements. So they differ by the type, the quality of capital, or whether you have risk-weighted assets or assets on the denominator. What the stress test is doing is basically the capital ratio of the bank is going to decrease because the bank capital has to absorb this hypothetical loss in the stress scenario. Okay, so we always end up with a capital ratio in the stress scenario that is lower than the actual one, but the requirement is still the same as the capital requirement on actual capital ratios for other banks. So what we are going to do is to translate this requirement back for its actual capital ratio, okay, so that we can make capital requirements comparable. Okay, so we have here an example for Citigroup, and so its actual capital ratio was 11.7. In the stress scenario, it decreased to 4.9. The capital requirement is 5%. Now, 5% is not anymore the capital requirement for 11.7, but for 4.9, right? So what is going to be the capital requirement for the 11.7%, for the actual capital ratio of the bank? We're going to actually use the fact that the capital ratio is decreasing in the stress scenario by 60% to derive what is the effective capital requirement of the bank on its actual capital ratio. And this is not 5%, but 11.9, so almost 12%. Okay, so we see here that actually 11.7, the capital ratio is not enough for this capital requirement. Okay, so this is a bit how we're going to define capital requirements, and so this is basically the effect of stress tests on capital requirements of banks. It's increasing capital requirements on average by almost 2% when you're a bank subject to the stress test. Now, I go right back to the result. And this is basically our regression. That's a regression at the bank level. So as I said, we're going to allow for a differential response to capital requirement between stressed and non-stressed banks. And this sensitivity of capital requirements will change after Dodd-Frank Act differently for stressed and non-stressed banks. Once you have control for that, you have basically the response, the differential response of stressed banks after Dodd-Frank Act that is not related to the level of the capital requirement. And that's what we are after, to show the effect of stress test supervision. And this is our result. So basically, if you don't control for this, you would not see any effect of stress test. Okay. But once we control for differential effect of the stress test on capital requirement, we this 200 basis points lower reduction increase compared to non-stressed banks after a Dodd-Frank Act. We find this, so this is a graphical illustration of our results where we show so here what we are going to look at is only the numbers after we have removed the capital requirement. So this is the average portfolio yield that is orthogonal to the level of the capital requirement. This is basically showing the effect of supervision. So the difference here in this residual portfolio yield was around 200 basis points, larger for stressed banks before the Dodd-Frank Act. And after Dodd-Frank Act, the difference in portfolio yield goes to almost zero due to the effect of supervision. Okay. We applied the same methodology, but now at the loan level. So here we're going to basically able to saturate the model with bank time fixed effects and firm time fixed effects, such that we look only at the matching level and find the same results. Basically, what we find is a relative improvement of the borrower rating by 0.7 classes. Okay, so let me conclude. We're in this context where you have regulatory arbitrage, you have this catch-up game between the regulator and the regulated institutions. And in that context, we see that banks react differently to capital requirements, especially when banks have this higher capital requirement defined by the Federal Reserve on an annual basis. We have to control for that in order to evaluate the effect of all the other initiatives that the Fed is taking when it is implementing the stress tests. We find that indeed stress test supervision work in encouraging prudent lending. And the bottom line of our message is to say that higher capital requirements or regulation might not necessarily always be a substitute to stress test supervision. Okay. Thanks. Thank you. I'll keep this.
Okay, thanks, Diane. So now the floor is yours, Vasso Ioannidou.
Yeah.
Ioannidou from Lancaster. She's going to discuss Diane's paper.
All right. So, how's this working? Yeah. Okay. Oh yeah. Okay. So thank you for inviting me, and it was a pleasure to read the paper, though I have to say a little painful, and I will explain. So this is a paper about stress banks and stress tests. So let me give a very short overview of what I take from the paper and then pass to my comments. So essentially, as you all have seen, the paper is looking and tries to evaluate the impact stress tests had on banks' risk-taking incentives. Now, when we are talking about risk-taking, we are looking at their willingness to lend to riskier borrowers. So it's the most obvious, most type of approach most papers in banking will do when they're looking on risk-taking. They will sort of look on the lending and willingness to give loans to riskier borrowers, and the analysis will be drawing from the syndicated loan market. So as Diane talked about, the challenge here is to try to distinguish, she explains, between the impact that the higher regulatory capital requirements that are coming through the stress test, to try to distinguish the effect of this from the extra supervisory scrutiny they introduce. Okay, and the paper essentially is built trying to distinguish these two. I'll take an issue with that. So I'll talk about this in a minute. The key insight that comes from the paper is that higher capital requirements, regulation, essentially, this is not a substitute. So regulation with capital requirements is not a substitute to extra supervision. Okay. In fact, one of the results I like a lot is the results about the correction of regulatory capital that they are finding. They do show that they are effective in terms of mitigating risk. So this is not surprising, but it's still very important to document and try to To me, if you have banks facing a minimum capital requirement, a rule cannot be a mechanical rule cannot be which by themselves they're going to use internal models to try to assess the risk of a particular loan. I mean, it's not surprising that they are going to arbitrage as much as possible, either by sort of skewing the type of assets given the particular risk, or underestimating the actual risk of something. So the need, the fact that just a capital ratio is not going to do a good job in curtailing risk as much as the extra supervisory scrutiny associated with that to actually see how truthful or how accurate these measures of capital really are, is not surprise that this will come through. I'm not saying this as being, it's not a surprising result. It's something that is natural, and I think it's important to document. Okay, so comments. So I think the question is very relevant. Okay, and there is a potential to contribute to the literature here. Okay, so I think it's important to understand what impact stress tests had on banks' risk-taking and lending policies in one particular aspect of risk-taking here. And I will add, it's in order to understand what impact they had over and above existing regulation and existing supervision. I will come back to that on my comments when I talk about them. So given where the current literature is on this, I think there is room for the paper here to make a contribution. So reading the paper, I learned a lot about stress tests. And the paper, while you read it, it stimulates additional thoughts, additional questions. So that was all very good. Now, having said that, I must say that there is scope to reduce both the length of the paper as well as the complexity of the paper. So I think it will sharpen the message and will make the results come through better. I think the length was useful for me to understand some of the background behind stress tests that I didn't have before I started reading it. But so maybe some of that can be moved to sort of an internet appendix. And that will also give space for some other key questions that that as I started reading, I was sort of looking, but what about this, what about that? And I couldn't find them there. And I think they're important to have. So I will rethink about this. And I think there is room for reducing the complexity of the analysis. Now, taking a stance that I don't think is necessary to make that separation. I think the separation is complicating stuff, but I will come back to that. So my set of comments from now on is going to be some sort of broad conceptual things I will talk about, and then some very specific comments about the analysis, okay? So the paper tries to distinguish between supervision and regulation. So for me, this distinction in the context of the stress test analysis is not clear, okay? I don't feel that you really need to separate the two. I don't really understand why they are different. So, I mean, if the regulators go in and they're looking at the assets of the company and they're trying to evaluate them about the different assets and try to evaluate what will be the capital that they will have and what losses they're going to have under a bad case scenario, is not these extra requirements that you are imputing and calculating. That's exactly happening, and you have these deviations and the differences precisely because there is supervision. With a mechanical rule, you wouldn't be able to do that. So for me, this is actually a result of the extra scrutiny, and the two are very difficult to disentangle between them. The other thing I wanted to say is that, to me, this adjustment between what is the real capital under different conditions and what a mechanical capital ratio will be is not a control, but it looks to me like it's a key part of your story. So I don't see it as a control. Throughout the paper, it's like, oh, we are not interested in that. We want to get rid of that and study the other one. In fact, the correction of capital requirements, which you have towards the end of the paper, in table 10, I think that's one key interesting thing in understanding the differences between what the ratio is and what basically is implied that it should be given what actually the assets are under different conditions and their quality. Maybe I'm missing something, but looking at it and reading the paper, I couldn't get really such a natural difference between these two concepts. The other thing that is missing for me it will be to try to have some discussion about how I should think of the stress test and the supervisory aspect of the stress test relative to existing things that were happening before they introduced stress tests. It's not that banks were not examined previously. I mean, these big banks that are subject to stress tests, they were part of annual on-site examinations every year. So how is this different in addition to that? One key aspect of this is disclosure. Yeah. So but even that is not entirely true, because when they do on-site examinations prior to stress tests, if they find significant failures, they are going to come and issue a formal action, which is also a public disclosure. Since 1989, they do issue formal actions which are publicly available, and they disclose problems with this. Camel ratings they never make publicly available, which is a rating that comes after any examination. But whenever an institution fails significantly, so I think has a camel rate around 3 or lower, or higher, depending on the direction, good or bad, how it goes, they're going to issue a formal action, assisted disease order or written agreement. So that's another form of disclosure. Okay, so what else is different? One aspect maybe is disclosure. It's as if they're making this thing now public, which before it was not, like bringing the threshold of disclosure earlier. Maybe, I don't know. What else is happening? Maybe it's production of information, but I mean, I'm sure they were doing production of information also when they were doing regular on-site examinations. It's clear to me that, these are what it implies in terms of regulation and capital regulation, because they are coming down to a number under a particular worst case scenario. So in terms of capital regulations, but on other broader aspects of management practices, lending policies, and so on, the management practices, I mean, they were rating them beforehand on this. So it's not clear to me what exactly it does. I mean, it's not that it doesn't, I'm sure it does. It's just I would like some discussion to frame how I should think of this given the existing and why we should have it. Because some of the discussions about the introduction of stress tests, they are actually, from a theoretical perspective, motivating them that are really beneficial in crisis periods in order to allow the market to distinguish and not have pooling equilibriums, but to be able to distinguish, and so not to have interbank markets freeze and so on. So it's not that we have lost this aspect. It's there, and it was always been. So let me go to some comments about the analysis. So one thing I would like to point out is that, I mean, the paper here draws from the syndicated loan market. So we all know that syndicated, if you focus on syndicated loans, you are going to tilt towards selecting on large loans and large firms, which is okay. So the way I look at this is maybe some discussion on this and maybe a comparison of how these results may compare to, say, the Cortes and Al analysis, which are focusing on small business loans, maybe contrasting. They're providing evidence sort of from the small business loans, and in your analysis is sort of looking at this, maybe compare the two, discuss how they may be different. I will think that if anything, these ones are going to be underestimating the total effect because you are focusing on the larger, more transparent firms. The other thing I wanted to point out is that a big part of the analysis focuses on sort of within facility variation, tries to sort of capture, here is a syndicated loan, and uses information about how much each particular bank has put in that facility. So try to use the information about, okay, this is 3 banks in the syndicate, and this one put this much, this one, this much. And this is done in order to sort of follow the Gaussian-Mian identification with bank time fixed effects, firm time fixed effects, and so on, to absorb demand and supply. This key information, however, is missing for 75% of the syndicated loan market, which is a pretty significant percentage. And so it will be important. So clearly that this creates some selection. Okay, so it will be nice to have some descriptives to give us an idea compared to the entire sample. What are you selecting? Is it random that the information is there, or is more for larger certain banks? So guide the reader about what segment of the market is the information available. And there maybe also provide sort of an earlier stage analysis where you use maybe less saturated specifications, but they're available for a bigger sample. So that's something, if you see that this is sort of picking and sort of an even further higher selection towards large, but it will be nice that the reader has some information exactly what is the selection that happens here. I would also like to have some more information about who are the treated and who are the control banks in the sample here and how they compare. You do provide some, but here is a few things that were still unclear to me after reading it. Because I mean, the stresses are done on the really large bank holding companies in the US with above 50 billion. So these are really large. I will think that these are going to be, if they're participating in a syndicate, probably they are the lead arrangers. Is it the case that indeed most of the time your treated bank is the lead and the participating are the controls are the participants? So are we systematically capturing leader versus participant by the division of treatment and control? You also at some point mentioned you have 48,000 unique lending companies. I mean, there are no 48 banks in the US, so you must be having, still, seems a lot. Is it only banks or you include non-banks as well? Anything. So then I mean, there is a growth of shadow banking into the syndicated loan market documented by other papers. So I mean, again, I'm pretty sure that a lot of the traders are really large banks, but on the control, you are maybe picking up a lot of non-banks, and whether that matters in the analysis. Now, in terms of one concern I had while reading this is whether your treated group, what you are picking up is the financial crisis. So clearly, when you are prior, you look for pre-trends and you redo the analysis before. And that is, as you will expect, you don't find the results there. That's great. Everything starts from the financial crisis, but clearly, I mean, is whether you are able to capture any possible difference to the financial crisis or access to interbank market to the extent that these are the very large banks. I wasn't exactly sure if that was completely absorbed. What else? So I found table 1 great. So where you show essentially, here is the capital ratios. Here what their implied capital ratios given the analysis from the stress test, and here what they have. So that was great. And also how you devise a procedure on figuring out one number that I can compare between each of these 3 cases. That was fantastic. The part that I didn't get, and I lost you afterwards, is that the key tables of the analysis, table 3 and 4, I was not able to understand how when you are adding this additional variable with the capital, and when looking at the definition, I could understand the equation and what it says, but when I was looking at the measure, it was looking to me, and I'm pretty sure it's wrong, that it looked like this was a function of the dependent variable. So you had delta, portfolio yield under stressed or not stressed, but which was the average. But is this sort of one of the explanatory variables a function? So that's great. But I will try to think if there's a way to write it in a different way, because looking at it, I was said it can't be that. But now the whole analysis with triple diff in diff, I personally find hard. I'm not convinced you really need to go there on trying to distinguish between the two. I mean, if you really need to, why not then simply have the correction component of the regulation, and then maybe collecting in the same way you have quantified the impact of the capital requirements, quantifying from the other aspects, the supervisory, the quality, the failure quality measures that are in this report, to create a measure for this and have a simpler version where you are running these two against each other. So yeah, that's some thoughts I had, but
Okay, thank you very much, Vasso. Diane, would you like to have some minutes to respond to?
Sure. Thanks a lot, Vasso, to going through the pain of reading all these pages. I know it's very long, and when I sent it to you, I was already apologizing. So for sure, what we need is to shrink now. This is the next step. So, I mean, a couple of very good comments, and also it is a long paper, but I realized that it is still not clear what we're doing. So this is very good to hear. So I will defend the triple definitive, because that's to me, this is the core of the paper, and this is the main innovation. And what you have to understand here is not that the capital requirement itself is a definitive variable itself, because you might think that we have actually something that is mechanical going on here. But it's not the case, because you can replace the capital requirement just with the risk weights, the ratio of risk-weighted assets to assets, and find that the exact same results. What it means is that banks react differently to capital charges. And, well, this might be the fact that, well, we have those stress tests, and that's why but it's not the level, it's not because you have a higher level of capital requirements that this is driving everything. It's really this heterogeneity in risk-weighted assets, in capital charges, that is, and banks responding differently to capital charges when they're subject to stress test, that is driving our results. And you can think of it of banks practicing more regulatory arbitrage when they're stress tested because they have higher capital requirement. And I think that's the whole point of the story, saying that when you have capital requirements, there is always room for regulatory arbitrage, especially when the capital requirements are high, because you give even more incentives for banks to try to reduce these capital requirements. And the effect of supervision then is the most important, because that's the effect of everything else that is not going to affect the capital requirement, but still banks are going to fail because, for example, they don't provide enough data to the Fed, they don't respond enough to the Federal Reserve demands. So this is very different from what happened before the crisis, because we are here in an environment when banks are stress tested. They need consultant because they don't have even the capability to respond to all the demands of the Federal Reserve. So we are in a situation where actually banks are failing the not capital requirements anymore, and they're failing the supervisory part, which is very different from Camel ratings, because Camel ratings are still something that is, you have a rating. Here you have something that is qualitative. So if the Fed is not happy with how you do, when you are not able to respond to how you, what's the assumption behind this parameter in your credit risk model, and you're not able to respond to a satisfactory level to the Federal Reserve, you're going to fail. I think this is very different, and this has become the most constraining part of stress test. Now that said, it's true, this is a complex paper because the two are interacting. And I think that the last part, as you mentioned, is interesting too, because that's where you have the interaction between the two. This is where the Fed is using supervision to actually correct for the capital requirement. And that's also something that is effective in reducing risk taking. So it is long. We need to reduce, and I really like that you brought up all these comments, because it's going to help us to, explain a bit better and more straightforward way what we're actually doing. Also, coming to the Cortes paper, they only look at stressed banks, and in our case, we have to compare to non-stressed to identify this supervision part. So here, in our case, it is absolutely crucial to have a definitive setting, to have these two groups of banks. The comparison here is intentional. And of course, we run into all this critiques that this is a non-random assignment, but just like it is always the case with regulation and supervision.
Okay, thanks so much, Diane and Vasso. Let's move to some questions from the audience. Are there any questions?
So I was wondering how you think about the nature of the shock. So as you were just saying, it's sort of there's non-known random assignment, and I understand that sort of your biggest difference is sort of pre and post Dodd-Frank, but sort of at a regular level, the stress test, the timing, and the sort of there's a lot of iteration across banks and regulators, right? So the extent of the stress test kind of surprise is not going to be a surprise, but there's going to be a lot of iteration, and these banks prepare for it. There's this paper by Jose Luis Pedro who finds that there's a lot of like regulatory window dressing. So at the exact point in time where you take the snapshot, that's going to be regulatorily relevant. Sort of you can do there's a lot of discretion to the extent of how then your balance sheet will look, right? So to what extent is this a shock? How do you think about this?
So may I reply now? Okay. So there is a surprise still for the quantitative part, so the capital requirement. Now, it's true that you have this back and forth on the supervision side, but what we are just saying here is that after the Dodd-Frank Act, you are more watched by the regulator. That's just the shock. Of course, there are some back and forth, and banks are adjusting to it. That's actually what we see, right? But this is just the effect of being more watched, in a sense, by the regulator, being under more scrutiny.
Okay, thanks so much. Any other questions? No? Yes?
Renee,
would you like to?
You know, being the first paper after lunch is always a...
I know. I was also a bit slow myself.
So forgive me if my question is not making sense. I'm like, I was wondering, is there any? So I was interested by the supervision versus regulation thing, and I agree with Vasso. It's tricky, right? But I was wondering, I mean, there are papers that look at, for example, if you are, there's these alternating schedules of supervision by like state and national regulators. If you can do anything, and maybe it doesn't work for the banks in your sample, but if you can do anything there to tease out how supervision varies. So regulation should be uniform, but supervision may not be uniform. And I think that would be really interesting if you could say something a bit more about the supervision.
Yeah, that was also one of your comments. It's true that the problem is here to have some data about that because it's qualitative. But I mean, having some data on just how many visits and this kind of things would be actually nice. The only thing that
don't even need to go that far, right? Because even if you showed, because there's this, I'm thinking of the Seru and co-authored paper where they showed that there's a rotating schedule if you're supervised by the state versus the national authority, and even if you showed that there's a difference.
I mean, here it's always the Federal Reserve. It's always we don't have that. But I mean, among what we did is among the group of stressed banks, we looked at the ones that are using what is called the advanced approach to derive the risk weights. So they're using their own models. And we find that for those banks, the assumption is that there is more supervision for those banks because they're using their own models compared to the other banks. And we find the results there too. But it's, I mean, most of the banks are using advanced approach. And I mean, it's more anecdotal, but that's something we have. I mean, also in terms of looking at the failures, we could do that, but at the same time, I think the effect also is coming from this fear of failing. Not only because you fail that you're going to react to it, but just because you're watched, you're going to react to comply with supervision. And I think we can try because I mean it's easy. We just add a dummy, but I think that there's also an effect of being more watched, even if you don't fail. You don't fail actually because you react in taking less risk. Yeah, yeah. Yes.
Okay, thanks so much, everyone. So then I suggest to go on with the second paper in this session, which is going to be presented by Dragana Svijanovic from University of North Carolina.